Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Daniel back on the show. Listeners, you're going to find the download link for this week's Trade of the Week in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage and look for the red button over Daniel's picture saying, looking for the download.
Patrick, for this week's Trade of the Week, Daniel Lacaille argued that while liquidity is supporting the markets, underlying stress is building in Europe and could hit financials with a lag. So how do you position for that potential divergence within global financials?
Eric, Daniel Lacaille's point was that the liquidity is keeping asset prices elevated, but the real economic stress is building underneath the surface, particularly in Europe. And while that hasn't fully shown up in the data, the transmission mechanism tends to hit with a lag through margins, credit conditions, and ultimately the financial sector. So rather than chasing what's already moved, this trade is about positioning for that delayed reaction, where Europe's financials begin to reflect the underlying strain relative to their U.S. counterparts. Now, what makes this setup particularly interesting, as I'm showing on page 3 of the chart deck, is that the European financials, as proxied by the iShares MSCI Europe Financials ETF, which is the symbol EUFN, has materially outperformed the U.S. financials, represented by the Financial Select Sector Spider ETF XLF since the start of 2025, with the EUFN up roughly 59% versus about 8% for the XLF. That relative strength has pushed the spread toward the upper end of its recent range, even as the underlying macro backdrop in Europe appears far more fragile. So rather than chasing absolute direction, the opportunity here is to fade that relative outperformance and position for a reversal, pairing a short position in the European financials against a long in the US financials to capture that potential divergence as macro stress begins to surface. From a trade construction standpoint, this is a classic long-short ratio trade where you're pairing a long position in the US financials against a short position in the European financials to isolate the relative performance. To implement it in a dollar-neutral way, with XLF trading around 51.71 and the EUFN near 36.99, that works out to roughly a 0.72 shares of XLF for every 1 share of the EUFN to balance that notional exposure. The objective here isn't to call the outright direction of the market, but rather to capture the spread between the two, expressing the view that U.S. financials should outperform the European counterparts. But for those who are concerned about the left tail risk in a broader market sell-off, you can introduce convexity by replacing the XLF equity with a deep-in-the-money call option. In this case, using the 85-cent delta, October 16th, $45 strike call option on the XLF, trading around $8.26, with roughly 169 days to expiration, providing high delta exposure that behaves similarly to the long stock on the upside. The key difference is that as markets move lower, the options delta will naturally decline, reducing effective long exposure and dampening downside losses. So you preserve most of the relative performance capture if the trade works, while embedding a more defensive convex profile if both legs come under pressure in a risk-off environment.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent Trade of the Week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's get to these equities. What are your thoughts here?
Patrick, the market's willingness to shrug off the Iran crisis is striking, to say the least. Clearly, the crude oil market got the memo. Mag 7 earnings were mixed, frankly, so it's hard to attribute all the strength in equities to that alone. I see parallels here to the COVID pandemic. Now, admittedly, it's not quite as certain in this case. In the COVID situation, we knew with certainty by the 1st of February that there was going to be a global pandemic, or I should say, anybody who was paying attention knew that with certainty by February 1st. Took the market a good month almost to figure it out after that. So it's different in this case because if a deal was suddenly reached tomorrow and the strait reopened completely and permanently tomorrow, then the pandemic level economic outcome on the global economy probably wouldn't occur. But frankly, all indications that I can see are that both parties are overconfident and happy to play chicken and wait the other out. The parallel to the pandemic is that if this goes on for 2 or 3 more weeks, then we really are facing a global energy price crisis that becomes inevitable and simply will not be possible to avert. It's not quite at that critical level just yet, although it is certain there will be a very significant disruption, the effects of which have not yet been felt. There's still room maybe to salvage this without completely crippling the global economy to the extent that COVID did. But if we go on a few more weeks, it really will be. And the assertions being made by President Trump that Iran is only 2 or 3 days away from being forced to shut in all of its production are just plain wrong. Sorry, Mr. President. JP Morgan is saying it's at least a couple more weeks before we get to that stage. And our good friend Jim Bianco pointed out on X that Iran does have a sort of nuclear equivalent environmental option, which is if they run out of storage to put that oil in, they could just open a pipeline someplace and start pumping that oil into the ocean. That would be obviously an environmental disaster if they were to pump, more than a VLCC, several million barrels of oil and just pump it overboard. It would pollute the environment and it would put all of the neighboring countries' desalination assets at risk. So I think that this is really pretty darn serious, and the president's perception that Iran is out of options and about to be forced to capitulate is probably not accurate. So I doubled down on my S&P hedge position on the spike to 7,200 that we got right after Wednesday's close. That was a gift, and I was quickly rewarded Wednesday night. As I'm recording this very, very early in the wee hours of Thursday morning, we're seeing a little bit of a bounce here, just coming barely above 7150 again. I won't be surprised if it's lower by the time you hear this. But frankly, anything's possible here. If we get another bounce to 7200 because the stock market just doesn't want to get the message, I'll add even more to my hedge. My theory, though, is that just like the pandemic, what's going on here is people are going to stay in denial because they've never seen anything like this before. And they're just not going to believe that what is clearly inevitable is actually happening until it has already happened. And that's starting right about now. In other words, the lag effect of global transit times. The oil takes several weeks to travel to its destination from the Persian Gulf. Well, we're finally getting to the point where those effects are now being felt in the sense that refineries don't have enough crude oil. They're not able to refine and produce finished products and so forth. We haven't gotten to rationing in very many places yet. Iran has announced that they're rationing, but almost nobody else is doing that. That's about to happen, and it's absolutely inevitable. We're going to have a shock as a result of this. Now, if the strait has already been reopened when that shock really starts to hit the market and there's a light at the end of the tunnel, maybe markets will kind of grin and bear it and bear through this. But I think what's more likely is if the strait remains closed for at least another week, which, as far as I can tell, is what all signals are suggesting is going to happen, then as we start to feel those real impacts, and we are rationing fuel all around the world, I think reality is finally going to set in with a time lag, just like it had a time lag during the COVID crisis. So we'll see what happens. No matter what, those effects that we're just starting to feel now are going to be felt for at least 6 more weeks. And if the strait stays closed for 3 more weeks, those lasting effects will be extended for months as a result of the shut-ins, which take a lot of time and money to reverse once they've been shut in.
Well, Eric, my take on all of this is that the macro fundamentals will prevail, but they always prevail over the longer term. On the short term, what we experienced was a substantial flows pivot driven by all sorts of systematic trading that created a huge squeeze to the upside and certainly threw fuel on the fire of reigniting the AI flows. And so we're now in a situation where these types of moves don't end or turn on a dime. Odds are that from this flows perspective, the market could stay at these elevated levels for weeks, if not a month or more, before the flows have room to pivot once again to a sell cycle. I do think that the longer term, all of the damage that's being done on a macro scale will end up manifesting in the equity markets. But with us at these elevated levels, it's going to be hard for there to be a bearish downturn on the downside. From an upside perspective, there are a number of the measured moves that we're doing that target 74 to 7,500. But one of the things that I was looking for was a bullish tailwind from these Mag 7s would be needed in order to really get that market up to that elevated level. From a market breadth perspective, while we're trading at these 52-week highs, the breadth of the market is under 50%, which is essentially means that 50% of stocks are actually in a downtrend. Really shows how concentrated this entire advance has been in this AI story and how important these Mag 7s rallying here is to keep this going. One way or another, there's going to be a point where the markets will have to take this macro condition seriously, but I'm not necessarily thinking it's imminent. All right, Eric, let's touch on this US dollar.
Patrick, we still have a big unfilled gap on the Dixie chart up to 99.38 from just after the first ceasefire announcement, and I still expect that to be filled maybe fairly quickly here just from the signal that we're getting from oil. President Trump has indicated that he's told his military commanders to prepare for a strike on Iran. If that actually happens and we've got bombs dropping again, that's probably what will give us that gap closing spike up on the Dixie chart. Crude oil is already signaling that that's coming. At least as of recording time, that hasn't happened yet. We're still looking at less than 99 on the Dixie chart. As of recording time, I won't be surprised if we get any kind of kinetic action out of this conflict. It suddenly takes it well up to 99.38, which is where that gap on the chart ends. And probably higher than that, depending on how big of a military barrage we get. Again, President Trump has ordered the military to plan for that, but at least as of recording time, there haven't been any bombs dropping. This weekend could be hot again. Now, eventually, I think the dollar downtrend will resume and resume in earnest. And the tape action that we've seen so far on the perception that we had an all clear as of last week seems to have already confirmed that view. So very little doubt in my mind that we eventually see a resumption of the secular downtrend in the dollar index, but not till we get up spike first, maybe a sharp one. Then we go back down after this conflict is really and truly over. We start to see the dollar sell off to new lows. I don't think that happens until the conflict is completely over, and I think that is still a long way off, unfortunately.
So, Eric, for me, this is all about watching the euro. We're pinned in a tight range. And for me, I consider the euro to be in a neutral zone between 116 to the 118 level. In order for us to see a deterioration in the euro, it would take a break below the 116 level, which would send the dollar index potentially on another bull advance. But we haven't seen that yet. We're right now at 117, right in the dead center of that kind of trade range, and really been trading sideways for weeks. We'll see what the next catalyst that emerges to potentially cause a breakout. But right now, it's very quiet and very inactive, and we're going to wait till it wakes up before putting on any big trades on our end. All right, Eric, let's talk about oil. Clearly a huge move on the upside. How do you size this up?
Patrick, this is playing out exactly as I expected it to. Remember what I told you 2 weeks ago, listeners? I said a big dip was coming, and that was the dip to buy. The very next day, you got a chance to buy $79 West Texas Intermediate crude oil futures. By midnight on Wednesday evening, just before recording time, we were up more than 40% in those 2 weeks to over $110. What does that annualize to? I only bought a small tranche of flat price futures and then a much larger tranche of time spreads. The time spreads are also performing extremely well. The news that hit the tape after I recorded the interview with Daniel Lacalle was the UAE, United Arab Emirates, pulling out of the OPEC alliance. That's really, really big news. My initial interpretation of what's going on here is the UAE has been complaining for years about what it considers to be unfair quota apportioning, where all the other producers were basically pedaling as fast as they could and still staying within their quotas. UAE, in order to comply with its quota, had to produce well below its capacity. And that meant that the UAE and Saudi Arabia were the only countries that really had any significant spare capacity. What this move signals is UAE is saying, baby, when this thing is over, we are going to produce. We're not going to worry about any quotas, and we are going to take advantage of the opportunity to produce as much oil as we possibly can to sell into the massive deficit that is going to be created by this crisis. Now, in the long run, the bigger picture here, I'm absolutely convinced, is that spare capacity is history. We were already pretty close to that point, and I think this crisis pushes us into a new regime in the oil market where we're not going to have spare capacity and OPEC effectively controlling the market. The UAE is basically telling Saudi Arabia, we're not playing this game anymore. We're going to produce as much as we want. At that point, Saudi is the only one that has any spare capacity. They're probably going to produce as much as they can in order to keep up with UAE. That will drive prices down when this conflict is over. It might lead to a rapid recovery of prices down to, I don't know if we're going to get quite to the levels we were at before the crisis, but we'll get close on all of that competitive overproduction. The thing is, longer term, what that actually means in terms of pricing signals is we're not going to have any spare capacity left. The market is going to be incredibly vulnerable in coming years to great big increases in price anytime there's any kind of disruption, because we don't have the spare capacity. If I'm right, if my prediction is correct that spare capacity is going to become a thing of the past and everyone's going to produce as much as they can, we'll bring prices down, but it means OPEC will no longer be able to manage markets and will no longer be able to contain any future upside price spikes. So I think that's the really big takeaway here, and it's going to look backwards in terms of the price signal that you see as the conflict ends. For now, though, I don't think the conflict's ending, and as these effects get felt by the global market, I think we're going to see continued upward pressure on prices until there is an actual deal to reopen the strait. As long as the strait stays closed, I think prices keep going up from here. A question I want you to ask yourself is, okay, Wednesday was a massive, massive move, $8 in a single day. What was the signal? What was the catalyst that brought that about? Well, President Trump threatened some more violence. Well, he's always threatening that. That's nothing new there. He was just reiterating threats he's made previously. Iran began rationing. Okay, wait a minute. If Iran began rationing, yes, it means they're running out. But if anything, that would be a signal that the end is near. In other words, it would suggest that maybe President Trump was right, that if Iran is rationing fuel, it means they don't really have the staying power that they claim to have. So it doesn't make sense that that would cause $8 up in prices. President Trump's no more Mr. Nice Guy comments, again, he's made these threats before. So we still saw $9 on the day on WTI. I think Brent was up even more on Wednesday. I think the reason is because those easily foreseeable impacts that the market has known about for weeks are finally starting to be felt. So the rubber hits the road when there's actually no tanker arriving to supply various refineries around the world with the oil that they need in order to continue refining. So potentially we get a risk of refinery shut-ins coming next. I think it's going to get much worse from here. Let's see if the stock market gets the memo. So far, it hasn't.
Well, Eric, I'm going to look at it a little bit technically here, which is that we broke some of these key breakout zones on the upside, which has jammed the upside window open again. And while there's resistance at its previous highs, this is clearly showing a new trend of flows coming in on a swing trade basis. And will be interesting to see whether 52-week highs here follow on this breakout. At this stage, there isn't any imminent deal. And so the tight oil markets inevitably are a tailwind for oil to potentially continue higher here. All right, Eric, let's talk about these precious metals markets.
Patrick, I de-risked my gold position considerably on Sunday night's bouts above 47.30. I sold more than half of my position. First time in years that I've done that because, frankly, the gold market tends to punish people who try to get cute and trade in and out of it, thinking they're going to outsmart the market. Now, the reason that I went ahead and took that risk and traded out of my position, despite the fact that I'm still convinced that we're eventually going to new all-time highs, and I don't think that this secular bull market in gold is over, is that it's now crystal clear to me that markets are just not yet discounting what I'm convinced is inevitable for oil prices. And as this oil crunch gets worse and the market finally starts to panic, I think it's going to bring us new lows in gold, maybe even a lower low below the 200-day moving average and even below the 4,100 low that we already saw. So again, I'm taking a pretty significant risk here. The reason I only sold a little more than half of my position is the gold market tends to punish people who get cute here. And if we suddenly have a resolution and the strait is open again, I think gold is going to rally and rally hard. But for now, I'm happy to step out of the way because I'm not sure how much downside is left in this market. And of course, what's driving gold to the downside is that as we see crude oil prices increasing, it sends a macro signal that basically makes it impossible for the Fed to do anything other than consider a rate hiking rather than cutting cycle in order to counter inflation. That's the risk to gold. That's the reason gold has been selling off, and I think we're going to see more of that before this is over. I hope I'm lucky enough to time my trades well enough to get back in close to the bottom and that I don't end up getting left behind if we see a whipsaw from here.
Well, Eric, when I really step back and look at what's happened here in gold over the last 2 years through 2024 and 25, we went through an epic bull market advance in gold, and we had a parabolic blow off in January. And since then, gold has been in a corrective phase. That corrective phase may now be more sideways. If there was another leg down, we could temporarily test 4,000. Overall, I'm long-term very bullish, but we have to first see where this corrective pattern finishes. And when we see basing and accumulation start to appear again, as of this moment, it's still in this primary downtrend. At minimum, I think the next buy signal is going to take a breakout back above 5,000 to really set in motion some sort of a positive feedback that gets a new trend going. Right now, things are very quiet in the gold market. All right, Eric, let's move on to uranium here.
Well, the market is pulling back modestly, and what's just a natural stochastic oscillators were starting to get overbought. Now they're rolling over. What's going to happen, though, if the broader market tanks when the reality of this global oil crunch finally hits the tape? I'm not completely sure because without a doubt, this whole Iran event is ultimately long-term bullish nuclear, and uranium names. The fundamentals here couldn't be clearer. The global economy is under serious threat, and we need to accelerate the nuclear renaissance in order to reduce our dependency, especially after that signal from UAE pulling out of OPEC means we're not going to have any more spare capacity in order to cushion future shocks. So when you really think this through, this is all super bullish nuclear and super bullish uranium. Thing is, the market doesn't work that way. A falling tide lowers all boats, just as a rising tide lifts all boats. And this could be a tsunami or a tsunami in reverse. I'm not sure what the metaphor is, but if this Iran situation isn't resolved in the next couple of weeks, we could be looking at a massive global economic dislocation on par with the COVID pandemic that could potentially result in everything selling off, including uranium stocks. So let's see what happens here.
I'm a little bit surprised by how quiet things have been. I mean, there's every opportunity for uranium stocks to have gotten some bullish tailwinds from the fact that these AI and data center story usually pairs it with some sort of an energy build out, and typically there'd be some flows. Overall, the uranium space seems rather quiet. I wouldn't interpret it bearishly, but certainly not active at this moment. It continues to consolidate, very similar to the way gold has been consolidating. And we're going to have to see when flows start to pivot again. But for now, we're in some form of a distribution cycle, and we have to just let it finish playing out.
Patrick, before we wrap up this week's podcast, let's hit that 10-year Treasury note chart.
Well, Eric, what we continue to see is a direct correlation of rates to inflation expectations driven by the next move in oil. And so as oil broke out here on the upside, so did yields. And now while I'm showing the chart on the 10-year yield breaking out towards 4.5 on the upside, you can see this on SOFR futures. You can see this on the 30-year. It doesn't matter where on the curve you go, we're getting that direct sensitivity to this move in oil. So I think that the one thing to just respect here is that if oil was to break out, which is not a certainty, but if oil was to break out above 120 and get running on the upside, that almost certainly puts some short-term pressure on this, causing yields to potentially break out back towards 2025 highs. And so will we get that? Let's watch the oil market. Right now, these interest rate markets seem directly correlated to this story.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. And also you can follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.